Every year, millions of people sit down with a pile of documents, a deadline, and a creeping sense that they're probably doing something wrong. They're not bad at math, they're not unusually disorganized. The system they're navigating is just genuinely structurally complicated, and it didn't get that way by accident. Tax complexity isn't a glitch, it's a feature. Or more precisely, it's the accumulated result of hundreds of policy decisions made over decades, each one reasonable on its own terms, collectively producing something that feels like a maze designed by a committee that never had to walk through it. The first thing to understand is that tax systems have never been purely about collecting revenue. If they were, they'd be much simpler. A flat percentage of income, applied universally, would raise money efficiently and require almost no paperwork. But governments have always used the tax system to do other things at the same time. To redistribute income, to encourage certain behaviors, to support families, to subsidize industries, to correct market failures, to reward homeownership or charitable giving or investment or having children or installing solar panels. Every time a government decides to use the tax code to pursue a policy goal, it adds a rule, and rules need definitions. Definitions need exceptions. Exceptions create edge cases. Edge cases generate disputes. Disputes produce case law and administrative guidance. And all of that accumulates, year after year, government after government, without anyone tearing down the old structure first. This is the root of tax complexity. It's not one complicated system. It's dozens of overlapping policy objectives expressed through a single legal document that nobody ever fully rewrites. Here's a pattern that repeats itself constantly in tax policy. A government wants to raise revenue. It proposes a broad base. Tax as many things as possible at a relatively low rate. Simple, efficient, hard to avoid. Then the lobbying begins. Industries argue that taxing them will kill jobs. Homeowners argue that mortgage interest deductions support family stability. Farmers argue that their cost structures are unique. Charities argue that removing their exemption will harm civil society. Small businesses argue that the rules designed for large corporations will crush them. Each argument has some merit. Each argument, if accepted, creates a special rule. And here's the political reality. Special rules are much easier to add than to remove. The people who benefit from a specific tax break know exactly what they stand to lose. The general public, which might benefit from a simpler lower-rate system, doesn't feel the cost in any concrete way. So the political pressure is almost always asymmetric. Strongly in favor of keeping existing carve-outs, moderately against adding new ones, and rarely strong enough to actually clean up the whole system. This is why most tax codes grow over time. Not because complexity is the goal, but because simplicity has no organized constituency. Even if a tax rule starts simple, defining it precisely enough to apply it fairly generates complexity on its own. Take the concept of income. What counts? Wages, obviously, but what about tips? What about gifts? What about the value of employer-provided health insurance? What about stock options that haven't vested yet? What about cryptocurrency? What about bartering? What about the implicit value of living in a house you own rather than paying rent? Every one of these questions has been litigated, legislated, or administratively decided somewhere. The answers aren't always consistent across different types of income. They're often the result of historical accident, political compromise, or the lobbying power of whoever's income was being defined. The same problem applies to deductions. What counts as a legitimate business expense? If you work from home, how much of your rent is deductible? What about a phone you use for both personal and professional purposes? What about a meal that's partly social and partly a business meeting? The line between a genuine deduction and a personal expense dressed up as a business cost is genuinely blurry. And drawing it requires rules, and rules require enforcement, and enforcement requires judgment calls. And judgment calls create disputes. This definitional complexity is one reason that tax professionals, accountants, tax lawyers, advisors, exist as a large industry. The system has become complex enough that navigating it is itself a specialized skill. That's a real economic cost, and one that falls disproportionately on people who can't afford professional help. Tax codes are not redesigned from scratch, they're amended constantly by governments of different political orientations, responding to different economic conditions with different priorities. One government cuts the top marginal rate and broadens the base. The next one raises rates and adds credits for specific groups. The one after that introduces a new category of income and a new set of rules to tax it. Each change is layered on top of the existing structure rather than replacing it. Over decades, this produces internal inconsistencies. Different types of income taxed at different rates for reasons that made sense at some point but may no longer apply. Phase-outs, provisions where a deduction or credit gradually disappears as income rises. That were introduced to target benefits at the middle class but create bizarre marginal rate spikes that can mean earning an extra dollar effectively costs you more than $1 in taxes. Old rules persist long after their original rationale has faded because someone still benefits from them and is organized enough to defend them. New rules get added without fully reconciling them with existing ones. The tax code becomes an archaeological site. each layer reflecting the politics and economics of a different era, all of it technically still in force. Another source of complexity is that a single tax code has to function for an enormous range of very different situations. A salaried employee with one employer and no investments has a genuinely simple tax situation in principle. A freelancer with multiple income streams, deductible business expenses, self-employment taxes, and retirement contribution decisions has a much more complex one. A small business owner, a landlord, a farmer, an investor. A multinational corporation, each operates under rules tailored to their circumstances, all within the same ostensible system. The problem is that these different rules interact. Someone who is partly an employee and partly self-employed, for example, has to navigate two sets of logic simultaneously. Someone who has both investment income and wages has to understand how different types of income are treated differently and why. In many countries, the same person may also interact with multiple layers of government, federal, state, or provincial and local, each with its own tax rules, sometimes harmonized, sometimes not. What's deductible at one level may not be deductible at another. Filing separately for each level adds time, cost, and the possibility of inconsistency. At this point, the obvious question is, why don't governments just fix this? Why not start over with a clean, simple system? The honest answer is that simplification is politically and technically much harder than it sounds. Every piece of complexity has a constituency. Eliminate the mortgage interest deduction and homeowners, a large and politically active group, lose a benefit they've built financial plans around. Remove the charitable deduction and nonprofits warn of catastrophic funding losses. Eliminate accelerated depreciation for businesses and investment patterns change in ways that are hard to predict. Every simplification that raises revenue is, from another angle, a tax increase on someone. There's also a genuine equity problem with simple systems. A flat tax on all income with no deductions sounds clean, but it ignores real differences in people's situations. Medical expenses, business costs, dependence, disability. Adding provisions to account for those differences is how complexity re-enters even the most ambitious simplification effort. Some countries have made genuine progress. A number of nations have moved toward pre-filled tax returns, where the government sends citizens a draft return based on information it already holds from employers and banks, and the taxpayer simply checks it and confirms. This shifts the burden of assembly from the citizen to the state. It doesn't simplify the underlying rules, but it dramatically simplifies the citizen's experience. The resistance to this approach in some countries, including the United States, has in part come from tax preparation companies whose business model depends on the process remaining burdensome. That's not a conspiracy theory. It's a documented lobbying dynamic that has shaped policy outcomes. Tax complexity is not just annoying, it has real, measurable costs. Time is the most obvious one. Collectively, citizens spend enormous numbers of hours every year on tax compliance, filling out forms, gathering documents, checking figures. Filing returns, that time has economic value. It's time not spent working, not spent with family, not spent on anything productive. Money is the second cost. People who can afford professional tax advice pay for it. People who can't either make mistakes, miss legitimate deductions, or simply pay more than they need to. Tax complexity functions as a regressive system within the system. The wealthy can optimize their obligations with expert help, while lower-income filers navigate alone. The third cost is trust. When people feel the system is too complex to understand, they're more likely to assume it's rigged. Complexity becomes a vector for cynicism, and cynicism about the tax system feeds into broader disengagement from public institutions. There's also the compliance gap, the difference between what's legally owed and what's actually collected. Some of this gap is deliberate evasion, but a meaningful portion comes from genuine confusion, honest mistakes, and the sheer difficulty of knowing what the rules actually require. Tax complexity isn't the result of bureaucratic incompetence or malicious design. It's the predictable outcome of using a single system to pursue dozens of overlapping goals across millions of different situations over many decades without ever fully cleaning up what came before. Each layer of complexity was added with some rationale. Taken individually, most rules make a certain kind of sense. Taken together, they produce something that feels impenetrable. Because in many ways, it is. The thing to understand is that simplicity in tax policy always comes at a cost to someone. Every deduction removed is a benefit taken away. Every rate flattened redistributes burden. Every clean rule ignores some real-world complexity it was probably trying to accommodate. Simplification isn't free, which is why it rarely happens as completely as reformers promise. What you shouldn't walk away thinking is that tax complexity is simply the government making things needlessly difficult. The difficulty is real, but it's embedded in genuine policy trade-offs, historical accumulation, and political dynamics that don't resolve easily, no matter how obvious the solution looks from the outside. Understanding that doesn't make your tax return any easier to fill out, but it does explain why, year after year, the problem never quite gets fixed.